Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Debt Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. We continue to see pressure on global yields moving higher as markets increasingly price in higher monetary policy paths, led by the US, but also elsewhere. This has in turn created additional pressure on risk assets, and has not fully brought about the period of calm that I was hoping we would see, and really expecting in the near term, having believed that markets had priced in enough when it came to central banks and their tightening paths for now. I had to hear the internal voice telling me I should know better. Markets do tend to overshoot, especially early in the year. But objectively, I do think that still yield curves are priced in enough for now, even if said stability has not yet emerged in full. Maybe we just need to get past the Fed meeting next week to see some more two-way trading in the markets. Be that as it may, I must flag that I've been highly focused on Western monetary tightening and remiss in not focusing enough on China. Sure, partly this is due to the fact that markets are primarily focused on monetary tightening, but I don't want to lose the sight of the fact that we have a very divergent path to policy in China right now. While I've not fully worked out myself all the ramifications, I do think that as the year wears on, the implications of China easing, while much of the rest of the world is hiking, has yet to be fully seen. Thankfully, I'm joined by our Chief Economist, Peiqian Liu, to help figure this out, or Chief China Economist, pardon me. Peiqian, it's late there, so first, thank you for joining me. I have a couple of questions, but perhaps I'm going to start with an overall update. What's your most recent outlook for Chinese growth? I'll note this is also, we're recording this on the heels of some important Chinese data and an easing just this past weekend that you were calling for.
Thanks, John, for your questions. China indeed released its Q4 and full year GDP data earlier this week, which turned out to be in decent shape. Q4 GDP coming at 4% year on year, slightly above the market expectations. The full year GDP was also at 8.1%, which is also well above the government target of 6% for this year. But taking a look into the details of the data, it's really not as good as the headlines been suggesting. The headline GDP data was contributed by 1.7 percentage points from net exports, which means the external sector has been an outperforming sector for China. Stripping that out, the domestic demand contributed to just around 6.4 percentage points of the overall GDP growth. Diving deeper into December data, which turned out to be a little bit more disappointing, we have seen three major pockets of weakness coming from December data. Firstly, consumption is not as good as we would expected. Retail sales missed expectations by a fairly large margin. Secondly, within fixed assets investment, property investment slowdown has caught our eyes, as our calculation of year-on-year growth in property sectors have fell into negative 13.9%, which is the second largest monthly fall just after the March 2022 data, which was the onset of the pandemic. And lastly, employment was not optimistic either, seeing a slight uptick to 5.1% year on year. So all these pockets of weakness makes us think that a more aggressive easing is warranted. In fact, the PBOC has delivered that easing by cutting benchmark rate by 10 basis points earlier this week.
All right, so going forward, it sounds like the data is not quite as good under the hood. If there's more easing to come, what do you feel is the timing of that? And not just the timing of it, are there specific triggers that people should be watching for? Data, inflation data, growth data, property sector. What are your thoughts there?
Yeah, definitely we're going to see more easing coming since the policymakers have signaled their strong intention to stabilize growth rates. So we think that we still look for another 20 basis points of rate cuts and perhaps one or two 50 basis point triple R cut each. With regard to the question on the timing of the data of the rate and triple R cuts, I think we have a few specific indicators that we could be looking out for. I don't think inflation will be a major constraint to PBOC's easing as it's set to normalize this year, both in terms of PPI and CPI readings. But rather, I would pay more focus to the loan structures within aggregate financing data. December aggregate financing data showed very disappointing demand for loans. So if that continues in February and March, there is a high chance that the PBOC might continue with rate cuts to encourage banks to give out loans. Within real activities data, I think property sector slowdown and consumption slowdown will make the policymakers more willing to roll out easing policies. So late Q1, early Q2 are probably good time windows for these easing policies to be rolled out.
Okay. And lastly, what are the biggest risks to the outlook for China? I mean, we know there's a lot going in the property sector. We know that China has a very different approach to COVID than other nations, so clearly that's still a risk. But obviously, this is hugely important, not just for China and the region, but for global supply chains that China is so integral for. So, when you're looking forward, what worries you the most?
Yeah, so sure, certainly, I think there are three major risks to our outlook. Firstly, definitely a zero COVID strategy, as Omicron now tends to be more transmissible and it's harder to contain the virus without harsh lockdowns. Xi'an is one example. They have the harsh lockdown since Wuhan's pandemic in 2020. So with this sort of lockdown, we might be seeing more disruptions to services sector, to consumption, as well as to global supply chains. A second risk we see is probably the property sector slowdown. Not so much about the marginal slowdown of the property sector itself, but more concerns about policy responses. In this week's LPR announcement, interestingly, we only see 1 year LPR lower by 10 basis points following the benchmark cuts. The 5-year was actually lowered by only 5 basis points, which still signals a somewhat hawkish tilt towards the property sector deleveraging policies. So if policies remain tight amid the slowing down of the economy, we think there is a downside risks of sentiment and expectations changing, which might be causing a broader based slowdown of the entire economy. And lastly, I think the Fed hiking will definitely be one of the risks, as well as the PBOC diverge away from developed markets monetary policies. The narrowing rate differentials will be something on our radar to watch later this year.
Thanks, Peiqian. Really helpful. That's all the time we have for this week. As we look forward to this coming week, we're looking at preliminary PMIs from across the world and seeing how much follow-through impact there could be from Omicron in different places. German IFO survey, we've got some European GDP data, and of course, the highlight of the week is the Fed, in particular, keeping an eye on Powell's tone at the press conference. We'll see if we can get that sought-for stability in the markets. Thank you, Peiqian, again for joining us, and good luck with everybody this coming week. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.